So when we think about pulling from our accounts, maybe above and beyond the regular, there's a lot of reasons that can happen. What are some reasons that come to mind that you've seen with some of your clients?
I think the number one reason is going to be just an unexpected expense.
Right.
If you're having a monthly distribution be sent to you from your retirement accounts and an unexpected happens, that's going to be a reason to pull money out.
Welcome to the Semmax Way, the definitive podcast for mastering finance, investment, and retirement planning. Prepare to unlock the secrets to financial success as we delve into lucrative investment strategies and provide expert guidance towards a secure retirement.
Hello and welcome. My name is Matt Landon. Thanks to you for joining us with the Semmax Way podcast. I am joined here by Kyle Leonard.
Yes.
Kyle is a CFP and one of the advisors here at Semmax Financial Group. I also am a CFP and CEO of Semmax Financial Group. And today we are talking about times when you need to pull from your retirement funds, maybe above and beyond that regular distribution. It could be earlier on. You maybe not be at a point where you're ready to start retirement, but you feel like you need to tap into some of those retirement accounts. Maybe a situation where you have a regular distribution and you need to pull a little bit more. But that's what we're going to talk about today, was some of those different situations. And I think it's important for us to talk about this in a couple different ways.
Okay.
So when we think about pulling from our accounts, maybe above and beyond the regular, there's a lot of reasons that can happen. What are some reasons that come to mind that you've seen with some of your clients?
I think the number one reason is going to be just an unexpected expense.
Right.
If you're having a monthly distribution be sent to you from your retirement accounts and an unexpected happens, that's going to be a reason to pull money out at a different rate or unexpectedly. And the other reason I think is just whether it be a trip, whether it be something that you've been wanting to go do and you're like, when am I going to go do it? You just kind of make that unexpected decision to pull extra money out than what you have been, and it's just you just take it.
Yeah.
And there's nothing wrong with it.
It can be a one-time thing.
Yep.
It could be a reoccurring thing.
Yep.
Now, I would say I've had some clients that have called in before, and it hasn't actually been for anything for themselves.
Yeah.
It's usually for their kids.
Yeah.
It's like, or something comes up, or it might be a special request or something along those lines.
Yep.
But talk to me about somebody who's younger, so maybe not a retiree.
Okay.
Somebody who's still in their working years, or they may have just gotten laid off, so they thought they were still going to be working, but now they're in a position where they're in a crunch.
Yep.
They need to access some of their funds. Talk me through somebody who's, say, 50.
Yeah.
What should they be thinking about, and how should they be approaching things?
Yeah, I think the biggest thing is trying to understand, what are your options?
Right.
And making sure that you go through every option. I think the last one should be pulling from your retirement accounts. And it kind of goes back to what we've talked about in the past, is really figuring out what is the job of that bucket of money. What is the job of that money, and making sure that if it's for retirement, we keep it for retirement unless there's nothing else to pull from.
Now, one kind of counterpoint, I'm not going to argue, but I will
that's fair.
Present a different perspective.
Yeah.
Is if I hear that and I go, okay, so that's the last place I should go for money.
Yeah.
And I've got this credit card that has a $30,000 limit.
Yeah.
So should we be tapping into that first? Or at what point do you go, maybe don't touch the credit cards, pull from the retirement account first? Or kind of, how do you weigh that calculus?
Yeah. And I think it depends on kind of what it's being used for.
Okay.
And so I definitely would say try to stay away from the credit cards as much as possible if you're using the credit cards to live on. If you're making $3,000, $4,000, $5,000 a month, but you're spending $6,000 and you have to use those credit cards and you're swiping it every single month and it just keeps growing and growing, the balances just keep growing. So maybe time to have a hard look and decide, should we be using the credit cards to live on, or should we be tapping in and just going ahead and paying off? Because while your retirement account, your 401k IRA may be earning you 6, 7, 8, 9, 10%, the credit card's charging you upwards of 30.
Right.
So we're losing out on that interest. Let's go ahead and just pay off the credit cards and then have a discussion on getting back to living within our means.
Now, when you hear that, I think there's a lot to unpack there, and part of it is around that monthly distribution.
Yeah.
Right? Saying, okay, to your point, let's say I'm needing $6,000 a month to live off of. I'm currently having $4,000 coming in from various sources.
Yeah.
I've got a gap here.
Yeah.
Using credit cards to bridge that gap, you would argue, is a poor way to go about it.
Yep. Yep.
But what about a situation where I might say, okay, we don't want to use credit cards, but what are some other ways that I could access maybe a one-time lump sum of cash
Yep.
that I may need to pay back over time or not pay back, either way? But talk to me about either a 401k loan or like a home equity line.
Yep.
What about something like that?
Yeah.
That makes sense or be a better alternative to using a credit card?
Yeah, I think, and again, I think it's the situation, but I think, the 401k loan is a very valid reason depending upon what the situation it's for, because it's very quick. You can get the money pretty fast, and you're basically paying yourself back.
Right.
You're not having to go through the typical channels of applying for the loan, going through underwriting and all that kind of stuff with the bank or credit union or a loan institution. You can just go to your 401k, apply for the loan, get what you need, go ahead and pay that bill or whatever you need to pay, and then you just pay yourself back. I think if in an unfortunate event where you have to pull from a home equity line or a home equity loan to live on, if it's needed, we got to make ends meet. I mean, go ahead and do it, but making sure that we're only using this in a dire emergency.
So I think that's also where it's like understanding, why do we need these funds?
Mm-hmm.
What's the timeline for these funds?
Yep.
Because I will say the suggestion for, hey, I need these funds for a 3-month period.
Yeah.
And then I'm able to reimburse it.
Yeah.
That's very different than I have this one-time need. And I'm not going to be able to. There is no influx of cash coming in later.
Yeah,
it's not a situation where I'm putting a down payment on a house, but I'm going to be selling this other house and I'm going to have it back. In 6 months.
Exactly.
That's very different than I just need $50,000 or I just need whatever that amount is, and then put that against a situation where it's a one-time versus a reoccurring.
Yeah.
Right. So I think to your point, it's a lot of what's the situation and what are we solving for? Why are we solving for it?
Exactly.
But I do feel the clients who come to us or the people that come to us with questions.
Yeah.
And say, hey, I'm in a situation. Here's what here's what's going on. Thought that tends to go better, or you might be able to provide something where they go, I didn't even think of that.
Yeah.
In a different way than them just going, hi, I need to pull $130,000 out of my IRA.
Yeah. And it's like, wait, what?
Why?
Yeah.
Right.
Okay, let's talk about taxes.
Mm-hmm.
What's that going to do to your tax bill? Why do we need $130,000? Can we split it up over multiple years? At least over 2.
Yeah.
At the very least, but try to figure out what's that money needed for. But yeah, I think the biggest thing is kind of asking more questions to the clients and asking why are they needing extra distributions if it's above and beyond what they're normally taking. And is there a way that we can help them in a more tax efficient manner? Yeah.
And I had a client who called in, and obviously I'm not going to say any kind of personal details for
compliance reasons,
a number of reasons.
Yeah.
But they were in a situation where their son had he was going through a really messy divorce, and it was getting ugly. And their son was like, "Listen, I need to have an attorney who gets involved, and they're wanting a certain amount up front."
Yeah.
And they said, "Okay, we're going to front you the money."
Yeah.
But that was a shorter term thing because once everything settled out, they were expecting to get paid back.
Yeah.
That's different than, say, helping out your daughter with a down payment on a first home.
Yeah.
Right?
Exactly.
So I think understanding why we're trying to pull this bucket of money, what are we trying to use it for? It all comes into play.
Yeah.
How is that different than say somebody who's in their later working years or early retirement years and saying, okay, we need to pull funds because we're wanting to do a remodel on our home.
Yeah.
Right.
Yeah.
How is that different than that younger emergency?
I think again, I think it depends on kind of what the age is. If you're, between the ages of 55 and 59 and a half, you can absolutely pull it out of your 401k, but you have to make sure that you're no longer working. You have to be considered retired and be able to, that way then you can have access to that money. Once you reach 59 and a half, you can absolutely just kind of pull that money whenever you want from your retirement account.
Without penalty.
Without penalty. You got to pay taxes.
In both cases, we're paying taxes, but there's not the penalty.
Yep.
Now, I do want to put a point of clarification on there. You're talking about specifically the funds that are in the last 401k.
In the last 401k.
Last.
Yes.
And they had to have been 55 or turning 55 in the year at which they separated from service in order to be eligible to pull.
Yeah. So there's a lot of ifs. There's a lot of ifs in there.
But the answer to that is you can access your retirement funds at 57 or 56 or 58
without
years
penalty.
old without penalty and without having to go through the hoops or the stringency that a 72T provides.
Yeah.
So do you mind giving just a brief recap of what a 72T is?
Yeah, I don't do it very often.
I know it's very rare.
Yeah,
there's situations where it can make sense.
It does, yep.
But what is it for those that are uninformed?
So this is where you're taking money out of a 401k plan. You've retired, you've gone ahead, you haven't reached age 55, but you're like, I'm just ready. I'm 52. I don't want to go back to work, but I want to have access to my money. The IRS allows you to do what's called a 72T.
And that's because it's the tax code.
Yep. It's not
line 72, subsection T. That's what it is.
Yeah. And so it allows you to be able to pull what's called similar and systematically equal payments, which means every month, every quarter, every year, whatever you decide to take it, you're taking basically the similar payments until 59 and a half.
Or 5 years.
Or 5 years. As
Whichever
long as
is longer.
Yeah,
right?
Exactly. So if you're 52, you're taking it to 59 and a half.
But if you're 58,
you're taking it to 59 and a half.
Or you're taking
5 years.
In that case you're taking it to 63.
Yep, 63.
Right?
So it's just it's that's why we don't do it. It's confusing.
But the other thing with that is it's based on a formula on that initial account balance.
Yep.
And that formula is very rigid.
Yeah.
You don't have a lot of say in that.
You don't.
So it's like you might say, well, I don't need that much. Too bad.
Yeah.
Or I need to take more. Too bad.
Yeah.
You have to follow the rules in order for it to go.
And you have to make sure that it fits your situation, because if you decide that you want to do a 72T at 52 years old and retire, but the money that you're pulling out is not enough to live on, it might not be worth it.
So
because now you're going to have to figure out where you're going to make that gap up.
This is where I think working with a fiduciary is really key.
Yes.
And I'm going to give you 2 quick examples.
Okay.
One of them is I had a gentleman who came in. He was 57 years old.
Okay.
He had retired. And he was like, well, I'm paying this 10% penalty. And I said, why? He had rolled his entire 401k to an IRA because his advisor told him, move it all over. I'll manage it for you. And then you're going to have to pay a penalty, but we'll send you money every month.
Yeah.
If he had left a portion of that money inside of his 401k, he would have been able to access it without paying that 10% penalty.
Yep.
So for me, that feels like poor financial advice.
Yeah.
The second situation is for folks that are pastors, for example.
Yep.
And they have a not a 457, but a 403B.
Yep.
Now, if you have a 403B through a company like Guidestone.
Yep.
If you're a pastor, you're eligible for that
housing allowance.
Housing allowance.
Yep.
You knew exactly where I was going with this. So there are folks where I've told them leave part of that money in the retirement plan because you can still access that housing allowance in retirement.
Yep.
But you lose that advantage if you roll it all to an IRA.
Correct. Yeah.
So how often do you tell people don't roll it over to an IRA?
Again, it depends, but it depends on the situation. It's not very often. Most of the time when you leave an employer, it's recommended to go ahead and, whether or you're retiring, to go ahead and roll it over so you have more options, you have more flexibility. Because when you do turn 59 and a half, if you want to pull money out and you're still working or you have money inside of a 401k plan, even if you're retired and you're 62 and you have money in a 401k plan or you have money in an IRA, you have more flexibility on the taxes taking money out of the IRA.
Agreed.
As opposed to the 401k that has mandatory 20% withholding if you withhold taxes.
You also have a lot more options around how those funds are invested.
Correct.
So inside of the 401k plan, you're restricted to a handful of
15 to 20 mutual funds or whatever's offered.
Yeah. So let me ask you this. It feels like failure sometimes.
Yep.
When you have to deviate from a plan.
It does.
How do you handle or talk to clients about the emotional impact of sitting down and saying, we had a plan, we have to change something?
Life happens. I think that's what I tell everybody, is that life happens. If we knew from the moment we were born what was going to happen to the moment that we died, we wouldn't have jobs.
Yeah.
But having someone that you can sit down and have honest conversations with, and be able to explain and be open and say, hey, this happened. We need extra money. What's the best way and best path to go about it? Just having those conversations is crucial.
Yeah. And I think it's important to remember your advisor is not going to make judgments about you. But if we don't have the full story,
Yeah.
it's very difficult to give the appropriate advice.
I try to tell everybody, like, we're not the enemy. We're not trying to sit here and nitpick everything. We're on your team. We're on your side. Like, we're trying to figure out what's the best way to accomplish what you need to accomplish in the manner that is going to be the best suited for you financially. Making sure that we're putting you first.
So how do you build some of that financial confidence back? Once you go through, say, a financial setback and you say, okay, I had to take that large distribution I didn't want to, or you come down and you say, I never thought I was going to have an issue with credit card debt, but here's what's happened and here's where we're at now.
Yeah.
How do you kind of build that back or move forward and approach it differently?
Yeah, I think it's having those hard, honest conversations. If you're the client, having those hard, honest conversations with yourself and with your spouse, and then involving your financial planner along with that. But then also, modifying the financial plan. We set out maybe 5-7 years ago when the client first came on that, hey, this is the plan, and everything seemed hunky dory, but then life happens,
right?
And they have to deviate from the plan. Well, how can we deviate and get back on course, or do we need to change course and go somewhere else?
Yeah, I think it's really important to remember when we talk about a plan, there's constant revisions that come along with that.
Yeah.
It's like we're constantly making adjustments, revisions, changes, because there's changes that happen inside of a household.
Yeah.
There's changes that happen personally, but there's also changes that happen with market.
Yeah.
And your appetite for risk may change, and how you want your funds to be dispersed may change. And then separate from the market, separate from you, there can be governmental changes.
Yeah.
There can be all kinds of environmental changes where the situation has changed rapidly around you.
Yeah.
And I think it's important to keep that in mind.
Well, I would even kind of throw it back to you. When you sit down with a client and they've been clients here for 8 or 9 years, and then you work with them while they were working, that's when you started working with them, and then they retired, you never probably built into the plan that they were thinking of moving. And then they're like, hey, listen, Matt, we're going to move. It's like, well, that's not in the plan. Let's see how that looks.
Well, and it can go both ways. I've had folks where it's like, okay, now we need to figure out what moving looks like.
Yeah.
What is this going to do from a state tax perspective?
Yeah.
And what is this going to do from a capital gains perspective?
Yeah.
This is your first home versus your second home, and are you wanting to maintain a first home and a second home, or are you shifting everything, and how are we doing all that? But I've actually had it go the other way too. Okay. Where I sat down with someone and they said, well, we were always planning on retiring and moving. We had talked about that for years, and they said, well, we now have twin grandbabies. They're right down the street. We're not going anywhere.
Yeah, we're going to stay here.
We were always planning on doing this. It was like all of a sudden they said, I'm not doing that anymore.
Yeah.
Well, in one way, it was like, that's great. That there's a whole bucket of money that we had set aside that we can now do something different with. But it also really speaks to the idea that what matters to you changes over time.
Exactly.
And that's okay.
Yeah. It's 100% okay. Yeah. Because if we're not creatures who are going to hold the same thoughts and the same ethos for our whole lives. Things that matter change constantly. And so what mattered 5 years ago can be completely different than what matters now. Yeah. And it's okay. It's just, let's just build it into the plan and make it work.
I also think being honest with ourselves about what we're going to do in retirement, and whether or not this is a one-time distribution versus a reoccurring distribution. Kind of like we were talking earlier with the lifestyle creep or the spending. It's like, is this really a one-time thing, or has this come up before? Yeah. Because I thought about a client that both of us have worked with, and wonderful couple, but it seems like every year they come in and they have credit card debt. Yeah. And we talk about it. We pay it off. Do we need to raise the distribution? You have the funds available. Yeah. No, I don't need it. Next year, it comes up again. Yeah. The year after that, it comes up again. And it seems to be a reoccurring thing. So I think it does take some honesty around what do we actually need, and what's the best way to utilize this moving forward.
Absolutely.
So kind of on that note, kind of final thoughts. Let's circle back around to the mindset. And if you're in a position where you need to take a large distribution, if you were going to give somebody not necessarily the 1, 2, 3 of this is exactly what you do. Yeah. But if you were going to say, how should I think through this? Yeah. What would be kind of the key takeaways where you would say, here's where you start. Here's the things you need to consider. Maybe that critical thinking process. Yes. To a situation. Yeah.
The first for me is going to be the need. What is this money going to be used for? What are we paying off? Are we paying off a debt? Are we paying off a bill? Like what are we trying to sustain something for a short amount of time? It just really depends on kind of what the need is. Second is going to be the taxation, depending upon where you're taking that money from.
Right.
If you're taking it from retirement accounts, we know that any money that you've already earned plus the money that you're taking out is gonna, is all going on as income. If you're taking it from a non-qualified, whether it be a joint or individual non-qualified account, there could be capital gains that we have to be careful about. And then third, figuring out a way, if it's possible, how we can start paying ourselves back to make that money up, and to make that distribution up. If it's not there, it's not there. But if we can, how can we work over the next few years to make up that difference, make up that gap again, to make sure that we're filling in the hole that we just took?
Yeah.
Yeah.
And then if you had somebody who said, well, I've got an easy solution to that tax one. Number two, I've already got an answer. I'm going to pull it all from a Roth.
Yeah.
Why would you want to do that or maybe not want to do that? Again, just kind of thinking through
and there's a lot
of your options.
Yes, there's a lot to consider. Where's that Roth? How did that money get into the Roth? Did it get there from contributions or conversions? How long has it been in there on the contribution side? If you're under the age of 59 and a half, you can absolutely pull the money out. But if you're taking more than the contributions, you're going to get taxed on the gain now. If you've done a conversion and you haven't met the 5-year window for each conversion, you're going to get taxed and penalized. It's just, there's a lot to consider.
Yeah. So basically,
it's not as easy as just saying pull it from the tax-free account.
The Roth doesn't mean everything's free automatically. No. Don't worry about it. Just pull it and don't consider it.
Don't do it. I mean, it's one of those. It's not to say don't do it, but it's sit down with it. Sit down with your advisor. Sit down with, if you don't have one, sit down with an advisor or someone that you trust that we can go over. Hey, this is what I'm thinking. Give me a second set of eyes.
Yeah.
Yeah.
If you were going to kind of take final thoughts, take it away. What would be the thing you would want folks to take away from this full conversation? Because I know we've touched on a lot of different ways. There's obviously different tax strategies. You can mitigate your tax bill.
Yeah.
Obviously, there's different ways that you can create that cash.
Yeah.
One thing that we didn't even touch on that I've seen come up a couple times is folks that are doing things on margin, like doing margin loans. Now that's on non-qualified funds, obviously. And then you're going to have, if we have a big market drop, then you're going to have some of those margin calls come in.
Yep.
But that can be an option, but it can also be very costly.
It can be.
There's a lot of strategies available.
Mm-hmm.
In your opinion, is there one more than others that you would say, yeah, if at all possible, please don't do that? Whether it's reverse mortgage, margin loans, credit card, what would be the one where you were like, please, that's the last resort?
Oh, that's a good question. If I had to say one as the last resort, and I guess it depends on kind of the client's age and also what their account balances are. I tend to kind of stay away from margin.
Yeah.
I really don't like it. I don't like reverse mortgages anyway either, but at least with a reverse mortgage in a worst case scenario, you're going to get to stay in the house.
Yeah.
With a margin, you don't know what that bill's going to look like if we have a big drop in the market. You could be taking margin out when we're at all-time highs, having the market drop, and now you're having a big margin call. And if you don't have that money available, now you got to sell to make that money available, which is a taxable event. It's a big risk.
It's a big risk.
It's a big risk.
Yeah. I'm inclined to agree with you on that. The other thing I would say with reverse mortgages is understanding really the nuance of what you're signing.
Yeah.
And that holds true. Same thing for margin loans.
Yep. Making sure that you understand.
I think most folks have a pretty good idea of how credit card debt can affect them.
Yeah.
But thinking through, what am I really signing up for here?
Yeah.
Because margin sounds much more attractive than it ultimately is.
Yeah.
And for those of you that don't know, all a margin loan is when you own after-tax stocks. If you own, let's say you have a bunch of NVIDIA or a bunch of Apple stock and you've been holding on to it for a long time and you say, I don't want to sell it, but I want to put it up as collateral. You can put it up as collateral. You haven't sold it. You still own the stocks. Then you get a loan. You pay the loan back, you hold on to you keep your collateral. But the problem is that stock is variable.
Yeah.
So you might say, hey, I have $250,000 worth of stock. I only borrowed $200,000. But if the stock market starts dropping, they're going to close it out. They're going to say, wait a minute, you owe us $200. We're going to sell to make sure you have the capital for what you owe.
And you've signed on to that.
And that can trigger a huge tax gain that you weren't anticipating. So I would say with most things, it really comes down to the details.
It does.
And understanding the nuance of not just what's the flashy headline.
Yeah.
Because there's a lot of headlines that make it sound like you can do this. Okay, great. How is this worst case scenario?
Yeah.
How could this possibly go wrong?
Yeah.
I think sometimes our job as an advisor is to think about what are all the ways this can go poorly?
Yeah.
And how do we avoid that?
Because if it all goes great and everything's hunky dory,
then everything's fine.
It's very easy.
Yeah.
Yeah.
Well, I would just say this. If you're somebody who's in a situation where you're facing some changes and you've got questions, reach out to our office. We're here to help. But also, if you're listening to this and you're thinking, man, this reminds me of something I did when I was 40 years old and I really wish I had known better, pass it on to somebody else that you know. Share the conversation, but also just understand, regardless of where you're at now, there are paths forward. There are options. There are different things available. And it usually helps to get that second opinion from someone because they're able to look at things with those fresh eyes.
Yeah.
Right?
Yeah.
So we thank you so much for listening in. I hope you have a wonderful afternoon. And on behalf of myself and the entire Semmax team, we hope you have a wonderful day.
Thanks for joining us for another episode of the Semmax Way. If you're not completely satisfied with your current financial advisor, give us a call for a second opinion. Please note that this podcast is intended for informational and entertainment purposes only. The content shared on the Semmax Way should not be considered as investment advice. It is always recommended consult your licensed investment representative and a competent tax advisor respectively for your fiduciary needs and plans. No statement contained in the Semmax Way podcast or made by its producers, sponsors, host Matt Landon, or Semmax Financial Group is a recommendation. Semmax Financial Group and Matt Landon are not responsible or liable for investment value loss of any kind from any action taken based on information discussed in the Semmax Way podcast. Any opinions or viewpoints in this podcast are shared for information and entertainment purposes only and are not financial advice. We do encourage you to conduct further research and seek personalized advice for your specific financial circumstances. Full disclosure available at semmax.com/podcast. Thank you for joining us, and we look forward to having you tune in for future episodes of the Semmax Way.